Hi, everybody. As usual, I hope you're all doing well. And when I say that, I truly mean it, you and everybody in your household. I hope everything is good. And listen, I know that a lot of these economics things that we've been talking about and the assignments that I've been asking you to do might be a little bit boring, dry, frustrating because it's hard to understand. But listen, knowledge is power. And I want you to be able to understand the basic functions of the federal government and economics. And this is a good foundation for being able to do that. If you can't do it right now, this minute, at least you're trying and you're getting a foundation that you can build on. And that's really important because knowledge is power. And I truly mean that. Because when you see, like, the Federal Reserve is our focus today, and the Federal Reserve influences our lives because they control the ever important interest rate. But what is the Federal Reserve? The Federal Reserve is the central bank of the United States. And it was created in 1913 to promote economic stability as part of the Progressive Era. And the Federal Reserve is an independent agency, meaning that Congress can't pass laws that tell the Federal Reserve what to do. The president is not supposed to tell the Federal Reserve what to do because it's independent. We rely on the Federal Reserve to make the decisions that are best for the consumer and that will promote an economy and help build an economy that's sustainable and friendly to us, the consumers. The only political thing about the Federal Reserve is that the president has the power to appoint the chairman of the Federal Reserve. And that appointment, like others, must be approved by Congress. So the organization of this federal banking system is very easy to understand. And there are 12 member banks. There's one in Cleveland. Okay, they're split up across the country. And those banks are there for, within that Federal Reserve district, for banks to commercial banks like First Federal of Lakewood, for those banks to go and borrow money. Okay, the Federal Reserve and its board of directors, that's headed by a chairman. The current chairman is Jerome Powell. They make key and important decisions. And one of the things that they do is they set what is called monetary policy. And we are going to look at three key monetary policies to help us better understand this system and how the Federal Reserve operates. Now, when we say monetary policy, it's actions that the Federal Reserve takes in order to influence the economy. And one of the important things that they do is they control the discount rate. And the discount rate is the rate that the Federal Reserve charges in order for reserve member banks to borrow money, because banks sometimes need to borrow money too. And that influences our consumer interest rates. And interest rates are an incredibly important thing for the economy, because let's say that we're having, like, our current economic crisis. One of the very first things that the Federal Reserve did is they announced an interest rate cut, because when interest rates are low, consumers will borrow more money. And when consumers borrow more money, we spend more, and this is good for the economy. Let's watch a little clip about it together to get a sense of why they would do that. This is a clip from CBS This Morning a couple of weeks ago when the Federal Reserve made this announcement. Keep in mind, too, that throughout your lifetime, the United States Federal Reserve has kept interest rates incredibly low to keep our economy going because of that 2008 crash. And right now, of course, we're in the midst of an economic emergency. So rate cuts are necessary.
The Federal Reserve is taking sweeping action to try to protect the economy from the coronavirus. Fed Chairman Jerome Powell announced that interest rates will be drastically cut in one of the biggest Fed moves since the 2008 financial crisis. Weijia Zhang is at the White House for us, where President Trump applauded the reduction.
Weijia,
good morning. So what led to this decision?
Well, good morning, Tony. Chairman Powell stopped short of using the word recession to describe what's ahead. But this surprise announcement is certainly a clear indication that the Fed is concerned about how the coronavirus is going to impact the global economy. The Fed cut its benchmark rate by a full percentage point to a range between 0 and 1/4%. And starting today, the Fed will start buying $500 billion in Treasury securities and $200 billion in mortgage-backed securities in order to introduce money into the economy.
All right, let's stop there. What on earth do they mean by securities? Securities is just a big word for investments. It's a big word for assets. Assets are things, are money, okay, capital. And the way that they also influence the economy, the Federal Reserve, is through the buying and selling of bonds and securities. And I want to describe bonds to you really quickly. And bonds are basically investments that are sold by the government to raise money to fund government spending and to deal with that debt issue that we talked about last time. And so government bonds can be bought, and you buy them for an initial amount, and you don't cash them in right away. They are something that are considered to be a long-term investment. You can buy 10-year bonds, 15-year bonds, or 30-year bonds. And over that time period, these bonds acquire interest. And that interest then is what you're going to earn. And at the end of the time that the investment is called for, you can cash it in for your initial investment plus interest that bond has collected. And they're generally considered to be very safe investments. So let's go back to the beginning and talk about 3 key things that the Federal Reserve does to influence the economy. The first one is open market operations. And those are when, just like they just said in that news clip, when the Federal Reserve announces that it's going to buy and sell bonds. And when they want to help the economy, when they want to get the economy going, what are they going to do? They are going to buy bonds themselves. The Federal Reserve will buy those bonds. They'll sell bonds, and you sell bonds. Basically, they announce these auctions that financial institutions, individuals, and investment banks go and buy these bonds, and it helps keep the economy going. Again, I understand that this is so difficult to understand, but we're just trying to get a general idea, so stick with it. All right. So open market operations refers to the buying and selling of government bonds. You're going to notice too that it works similarly with our interest rate when the Federal Reserve will adjust what they call the discount rate. And remember, that's the rate that the Fed charges to financial institutions when they need to take out a loan. And then that in turn influences our interest rates when we go to borrow. So when they want to expand the economy, all right, they will reduce this discount rate. And when interest rates are lower, we, the consumers, will be more likely to borrow. Interest rates for your entire lifetime have pretty much remained at historic lows. And right now, the interest rate is as low as it possibly can be. Okay, if we start experiencing inflation, the Fed can help cut inflation by increasing the discount rate, which will then increase interest rates and make it more expensive for us to borrow money. All right, so, and a third and final Federal Reserve policy is adjusting the reserve requirements. So each bank, because the Federal Reserve, another thing that they do is they set rules for banks. And in doing that, they require each bank to maintain a certain amount of money within their banking reserves. And then that influences how much that bank has to lend to us, the consumers. And by increasing the reserve requirement, okay? That means that banks have to hang on to more money and they have to lend less and will spend less. And when consumers spend less, prices go down. Okay, when they decrease the reserve requirement, that means simply that banks keep less money in reserve and they loan more money out to stimulate the economy, to get us, the consumers, spending. Today's assignment is very easy. I am going to ask you to use this Investopedia website, and I offer this website on every assignment because I really think it's a valuable and beautiful website. It explains things so well, and it even offers little video clips that help us understand things a little bit more. Okay, so I want you to keep on trying. Okay, do these basic definitions and terms, and it's so easy. And really try to put things in your own words too. Okay, I'm going to wrap it up. I don't want to go on too long. And after this, there will be one more economics assignment, and then we're wrapping it up and moving on with our studies. Okay, all right, take it easy, everybody. Hang in there, and we'll talk to you soon.